Welcome back, everyone, to the Audacious Money Witch channel, where we talk about the magic behind the stock market. Yo, check it. This bull market is giving main character energy and keeps hitting new highs. Sitting on the sidelines right now is low-key painful. When a real opportunity drops, you gotta send it fast, or you'll totally miss that it's now or never moment. I'm telling you, Berkshire Hathaway is giving us a golden opportunity. In this video, I'm going to spill the tea on what's happening in the market this summer 2025, and then introduce you to Warren Buffett's empire, owning a piece of the Oracle's business.
We've got a really good group of businesses, some of them very big. Now, those businesses will earn more over time. And then what we're trying to do is add on to them and make sure we don't issue any shares in the process. So it's not a complicated process. And looking back, we'll always be able to do it better than we've done it. That's just the nature of things. But I feel the game is still a very viable one and will be for some time. It won't be forever. It can't be forever. But it's still got some juice left in it. Charlie?
Well, what's happened, of course, is the private businesses that we control have gotten to be a bigger and bigger percentage of the thing. For a great many of the early years, we had more in common stocks than the total value of the company. It was like a big portfolio of common stocks and a lot of businesses thrown in as extras. And now, of course, the private companies are worth way more than the stocks. I would guess that will continue, wouldn't you, Warren?
Sure, it'll continue. And the difference is when we're right about stocks, it shows up in market value and in net worth. When we're right about businesses, it shows up in future earning power, which you can see, but it doesn't jump out at you the same way changes in stock values do. So it's a different sort of buildup of value, and one is somewhat easier to see than the other, but the other is more enduring and does not require going from flower to flower.
That's kind of lit. No cap. Why is it so lucrative? Why is it time to buy BRKB right now? In just 3 months, U.S. stocks have swung from a dramatic April sell-off to new heights. This is why it's crucial to buy the dips of popular big-name stocks when the big sell-off comes. More on my trading strategy later. First, let's jump into macro, why the market is behaving this way. The trade war vibe check. Tariffs are about to mess up supply chains and raise costs. The impact is starting to show up in Q2 earnings now, but it's low-key delayed. But here's the flex. Warren Buffett owns a ton of companies that are basically anti-inflation, like oil, gas, Coca-Cola, and American Express. So by copying BRKB, we get a piece of that inflation protection and those earnings too. There's not much proof of major demand destruction from the tariffs yet. But things aren't exactly booming either. AI is still the main character. Despite the trade drama, U.S. tech giants are still dropping major stacks on AI. Microsoft, Meta, Amazon, and Google are projected to throw around $337 billion into capital expenditures in fiscal 2026. AI isn't just a buzzword. BlackRock said it's the most enduring and dominant theme, and the rally can go way further because these stocks aren't too expensive. If those stocks aren't expensive, then Berkshire is practically free. AI was a thing way before ChatGPT blew up, but it got depressed when inflation hit in 2022. It'll probably bust again if inflation comes back when those tariffs kick in. We don't want to jump in when things are hot. We want to get into stocks when everyone is hating on them. Plus, the weaker dollar is giving a major, underappreciated boost to U.S. earnings, especially for large cap companies that make bank overseas. The dollar's been down bad this year, and companies like Meta and Microsoft are already seeing hundreds of millions in revenue boosts from it. Speaking of Meta, before the AI hype, its market cap was neck and neck with Berkshire. Today, Meta trades at a PE of around 27. Meanwhile, Berkshire is chilling at a PE of around 12. A PE of 12 for Warren Buffett's company with a price to sales of 2. Are you serious? That's a total steal. Berkshire Hathaway has sold off since CEO Warren Buffett announced his retirement, but the fundamentals remain strong. The recent 12% BRKB stock decline is an overreaction to Buffett's retirement. People are hating this fact and thus makes it a hated or low-key stock in my eyes. Valuation aside, if you don't understand what you own, you can't buy it. So let me introduce you to what is Berkshire Hathaway. This is from Warren Buffett's word himself as per 10K of 2024. Berkshire's equity activity is a bit extras. In one hand, we own control of many businesses holding at least 80% of the investees' shares. Generally, we own 100%. These 189 subsidiaries have similarities to marketable common stocks, but are far from identical. The collection is worth many hundreds of billions and includes a few rare gems, many good but far from fabulous businesses, and some laggards that have been disappointments. Property casualty insurance continues to be Berkshire's core business. The industry follows a financial model that is rare, very rare. Among giant businesses, when writing PC insurance, we receive payment upfront and much later learn what our product has cost us. Sometimes a moment of truth that is delayed as much as 30 or more years. In recent decades, this money upfront, lost payments later model has allowed Berkshire to invest large sums float while generally delivering what we believe to be a small underwriting profit. We make estimates for surprises, and so far these estimates have been sufficient. Under a JIT, our insurance operation has blossomed from an obscure Omaha-based company into a world leader renowned for both its taste for risk and its Gibraltar-like financial strength. Moreover, Greg, our directors, and I all have a very large investment in Berkshire in relation to any compensation we receive. We do not use these options or other one-sided forms of compensation. If you lose money, so do we. This approach encourages caution but does not ensure foresight. PC insurance growth is dependent on increased economic risk. No risk, no need for insurance. All things considered, we like the PC insurance business. Berkshire can financially and psychologically handle extreme losses without blinking. We are also not dependent on reinsurers and gives us a material and enduring cost advantage. Finally, we have outstanding managers, no optimists, and are particularly well situated to utilize the substantial sums PC insurance delivers for investment. Over the past 2 decades, our insurance business has generated $32 billion of after-tax profits from underwriting. Meanwhile, our float has grown from $46 billion to $171 billion. The float is likely to grow a bit over time, and with intelligent underwriting and some luck, has a reasonable prospect of being costless. As for the investment side of the business, we own a small percentage of a dozen or so very large and highly profitable businesses with household names such as Apple, American Express, Coca-Cola, and Moody's. At year-end, our partial ownership holdings are valued at $272 billion. Understandably, really outstanding businesses are very seldom offered in their entirety. Very occasionally, they sell at bargain prices. We are impartial in our choice of equity vehicles, investing in either variety based upon where we can best deploy your and my family's savings. Often nothing looks compelling. Very infrequently, we find ourselves knee-deep in opportunities. Greg has vividly shown his ability to act at such times, as did Charlie. Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses, whether controlled or only partially owned. So with dollar getting weaker, those international operations will make more money naturally. Berkshire's activities now impact all corners of the U.S. We are not finished. Companies die for many reasons, but unlike the fate of humans, old age itself is not lethal. Berkshire today is far more youthful than it was in 1965. So why no dividend? Unlike Apple, Nvidia, Google, Microsoft, and Meta, Berkshire won't pay a dividend to their shareholders. In a very minor way, Berkshire shareholders have participated in the American miracle by foregoing dividends, thereby electing to reinvest rather than consume. Originally, this reinvestment was tiny, almost meaningless, but over time it mushroomed, reflecting the mixture of a sustained culture of savings combined with the magic of long-term compounding. So because there is no dividend, you can think of Berkshire as actually a growth stock that is traded for PE of 12. Why not own it for the long term? It's Buffett's company.